REITs have historically been some of the most rewarding investments of all time. They've generated right around 15% average annual returns for the past 20 years leading up to the pandemic. That's quite a bit more than the S&P 500 or even tech stocks. But unfortunately, whenever I talk to individual investors about their experience investing in REITs, they tell me that their returns have been in most cases a lot lower than the sector averages. This is because they make mistakes, they end up investing in the wrong REITs at the wrong time, and as a result, their returns are quite a bit lower than average. Hey everyone, this is Yossi. I run an investment firm that specializes in REIT investing, and in today's video I'm gonna talk to you about the 10 biggest mistakes that I see REIT investors make all the time. But before I get into it, if you could please like this video, it will help me a lot. Thank you very much. So the first mistake is reaching for yield. Investors will often come to the REIT sector looking for a high dividend yield, and they will make the mistake of going for the highest yielding REITs. There are quite a few of them that yield over 10%, but unfortunately these REITs trade at a high yield typically for a reason. They either have an over-leveraged balance sheet, a poorly aligned management team, or they have declining cash flow because they own struggling assets. As an example, today there are a lot of office REITs that trade at very high dividend yields because, well, offices are today struggling as we potentially head into a recession and increasingly many people work from home. But what investors should really realize here is that there's no benefit in earning a 10+% dividend yield if your share price keeps declining at the same time. Historically, the highest yielding REITs have been some of the worst performers in the REIT sector on a total return basis, and this is because of all these issues that I described earlier. From my experience, it's much better to go for a REIT that has a relatively high yield but also a growing one. So as an example, I would much rather own a REIT with a 6% dividend yield that's growing and safe fundamentals than one with a 12% dividend yield and highly risky fundamentals. Then mistake number 2, miscalculating dividend coverage. REIT investors will all the time looking at payout ratios based on FFO, which stands for funds from operations. It's a rough representation of the cash flow of REITs. It's what REITs typically report whenever they issue their quarterly earnings. But the issue with FFO is that it does not take Capex into account. And so typically the real free cash flow of a REIT is quite a bit lower than the FFO. And so you might have a REIT with an 80% payout ratio based on FFO, but then if you still deduct Capex, the dividend might be very poorly covered, if covered at all. To adjust for this, what we REIT analysts typically use is what we call AFFO, adjusted funds from operations, which still makes a number of adjustments, including deducting for Capex, removing the impact of straight lining of rents, and a few other things. So don't make the mistake of looking at payout ratios based on FFO. Then mistake number 3, overlooking the impact of Capex on the leverage of the company. Many REITs have leverage levels that may seem conservative at 30-40% loan to values and debt to EBITDAs of 3, 4, 5 times, which is quite reasonable for many property sectors. But then when you add the Capex and deduct that from the cash flow, you quickly realize that the REIT is heavily over leveraged and that it has very little financial flexibility. I made this mistake with a REIT called CBL & Associates. I recently posted a video on this REIT. I'll put a link on the screen. And in short, I thought that the REIT had an adequate balance sheet for its assets, but in reality it was quite heavily over leveraged because of all the Capex it had to spend constantly to keep its properties desirable. Then mistake number 4, trusting REIT management teams. Today, most REITs are well managed. They have internal management structures, which means that the REIT managers are hired as employees of the REIT. Their salaries are tied to some performance-based indicators to align interest between managers and shareholders. And so with most REITs, there are no problems, but there are also quite a few bad actors that suffer significant conflicts of interest. This is often the case of externally managed REITs, which will outsource the management to an outside asset management company. They will typically earn fees for the management of the REIT, and typically a portion of these fees are tied to the size of the portfolio, which will incentivize the REIT to grow as large as possible, often at the cost of diluting shareholders. And so it's very important that you look for conflicts of interest when investing in REITs. Externally managed REITs have historically performed a lot worse than internally managed REITs, as an example. And yet a common mistake that we see is that investors will favor the externally managed REITs, often because they pay a higher dividend yield, not knowing that the higher yield is the result of high conflicts of interest. Mistake number 5, focusing too much on quarterly results. Investors need to realize that real estate is a long-term investment. Things change relatively slowly from 1 month or a quarter to another or even a year to another, and yet investors will all the time overreact to quarterly news. They might perhaps the FFO per share comes below expectation and investors will rapidly sell off the stock and it will cause the REIT to crash. In reality, I think that this is a mistake. I'm not saying that you should ignore quarterly results, but you should understand that the value of real estate should be determined based on decades of future expected cash flow, and a quarter or two has very little impact on the fair value of a REIT. Mistake number 6, confusing book value with net asset value. In most sectors, investors will look at what we call book value. It gives you a rough estimation of the value of the assets net of its debt, but this cannot be used in the REIT sector to evaluate the value of the assets because according to US GAAP accounting rules, REITs must record the value of their assets as its historic cost minus annual depreciation. And so a consequence of this is that if you're a REIT like Simon Property Group and you've owned a mall for now, let's say 30 years, you might have fully depreciated your property already, and so on your balance sheet it might be valued at 0 despite actually holding a lot of value. Because of that, you cannot use the book value that's often listed in screeners. Things like price to book simply don't work for REIT. You will need here to come up with your own estimates of the book value, and that's what we call net asset value. By the way, if you want to get my net asset value estimates for every REIT, feel free to join my REIT newsletter for a 2-week free trial. We have an intelligent sheet with an estimate for every single REIT that exists in the US. This brings us to our next mistake. Mistake number 7, overpaying for REIT because you ignore its net asset value. As I mentioned just earlier, the book value cannot be used. It's very complicated to calculate the net asset value. And so because of that, most REIT investors will look at things like price to FFO and value their REITs simply based on their cash flow, and they will not use the asset-based valuation metrics like price to book. I think that this is a mistake because ultimately you want to know how much you're paying for a REIT relative to the value of the assets that it owns net of debt. To know this, I do a lot of hard work. I spend tens of hours each week trying to determine net asset values per share for each REIT. How you do this is that you first have to estimate the forward normalized net operating income for the REIT, then you apply the right market cap rate for it, and finally you deduct the debt. Mistake number 8, forgetting that you're investing in real estate and not in a tenant. When you invest in REIT, you're buying an interest in a diversified portfolio of real estate, and so yes, obviously you're going to have tenants that will pay you rental income, and so the health of your tenant is important to you. But I think that in many cases, REIT investors will overreact to news regarding the tenants of REITs. As an example, EPR Properties today is heavily discounted because some of its biggest tenants are going through some difficulties. But what REIT investors tend to forget is that if your tenant vacates your property, you typically can still release it to another one, assuming that you own desirable properties. So just because your tenant goes away does not mean that your real estate is worthless. On the contrary, at some times, it may even be an opportunity if it allows you to release the property to a better tenant at a higher rent. So next time you have a REIT announce some tenant difficulties, don't just blindly sell. On the contrary, this could be a great opportunity to buy more shares at a lower valuation. Mistake number 9, having a trader's mentality, and this is related to what I said earlier. A lot of REIT investors will trade in and out of their positions based on short-term news, and I think that in most cases this is a mistake. The best path forward is simply to react as little as possible to short-term news and instead focus on the long run. You want to let time for your REIT to compound its cash flow, pay dividends, because that's where most of your return is going to come from. There's been a lot of times where I've invested in a REIT, it has dropped significantly, and if I had panicked and sold, I would have realized very large losses. But because I was patient and I kept my eye on the bigger picture, I still end up recovering nicely from it and earning a nice return in the long run. So in short, patience is needed here. And finally, mistake number 10, failing to take advantage of opportunities when they become abundant in the REIT market. Here we can take today as an example. REIT valuations are some of the lowest in many years, and despite that, if you read the comment sections of REIT YouTube videos or articles on Seeking Alpha, you'll see that a lot of people are very pessimistic, and most people are failing to take advantage of these opportunities. They will cite the uncertainties like the war in Ukraine, surging interest rates, high inflation. I mean, there are always some negative things to point to when valuations are low, but despite that, if you look back, whenever we've gone through some big difficulties like the pandemic or the great financial crisis, those have been the best time to buy REITs because they've been very heavily discounted. Coming out of the pandemic, REIT share prices doubled in just over 1 year, and then coming out of the great financial crisis, REIT share prices nearly tripled in just 2 years. Yet, I'm sure that during those times, most people were not buying REITs because during the pandemic, everybody was saying that real estate is dead. During the great financial crisis, everybody was saying that REITs are going bankrupt. And again, despite that, those proved to be fantastic buying opportunities. And I think that this is true again today. Now, if you want to learn more about what I'm buying at the moment, feel free to join my REIT newsletter for a 2-week free trial. I'll put a link in the description. And otherwise, if you could like this video, subscribe to the channel, will help me a lot. Thank you very much. Bye-bye.